Today's lecture is examining some of the crypto trading strategies available to beginners. A lot of cryptocurrency trading decisions, such as portfolio allocation or finding the right kind of wallet, may highly depend on the strategy you have chosen to use in the market. For starters, let's name the most used strategies and briefly explain their fundamentals. There are also a few other strategies contained in the course notes. Crypto day trading is our first port of call. When a trader does day trading, he aims to utilize the daily movement of the price of a cryptocurrency. This strategy can become a career as it can take up even more than 8 hours of your time, since you have to be present in the market to make quick decisions in order to lock in those gains or avoid unnecessary losses. Next, let's look at crypto arbitrage trading. Arbitrage is a strategy where traders utilize the price difference of a single asset between various exchanges or disparity between more than two coins on a single exchange to make a profit. Since profits in arbitrage tend to be low in percentage terms, traders have to wield more than average amounts of funds for arbitrage to be worth the time spent doing it. Next, there is a strategy called crypto hodl, or put more simply, buy and hold. The previously mentioned hodling is when an investor does his fundamental analysis, finds the cryptocurrency with what he thinks is the one with the most long-term potential, buys it and keeps a hold of it for a longer period of time, usually more than a year, or until it reaches the predetermined price. Hodl doesn't take up much of your time apart from the initial analysis. And finally, we will look at shorting crypto. Why would you want to short crypto assets? If you believe they are overvalued, that the market is due for a correction for instance, or that a currency is mispriced compared to another coin, then shorting is what you should consider. Here are 7 ways you can do it. Perhaps the simplest way to short crypto assets is on digital asset exchanges that enable margin trading. Exchanges such as Bitfinex and Poloniex allow traders to short cryptocurrencies on margin. To short sell on a digital asset exchange, you need to borrow a crypto asset from margin lenders, buy the asset back once your target price has been met so that you can sell it back to the lender. The exchange handles the back end of this process, and you will be charged a borrowing fee for each day that you are shorting the asset. Your profit, or loss, will be the difference between the price you short sold at and the price at which you have bought the asset back at minus the margin lending fee, which differs from platform to platform. If you are using leverage, this profit or loss can be amplified by the leverage ratio you choose. Alternatively, you can also short cryptocurrency CFD or contract for difference on online brokerages, such as CMC markets for example. For investors who are more comfortable with trading on traditional online brokerages as opposed to digital asset exchanges, this may be the most suitable option for going short crypto. The process of short selling a cryptocurrency CFD is the same as on a digital asset exchange, with the key difference being that the profits are paid out in fiat currency as opposed to digital currency. From a user point of view, all you need to do is ensure you have enough funds on your account to cover margin requirements, and to hit the sell button on the cryptocurrency CFD of your choice at the price level you want to short it at. Daily borrowing fees also apply to CFDs. These need to be taken into consideration when short selling an asset. The longer you hold onto your short position, the more the borrowing fees will add up. If you want to short cryptocurrencies such as BTC or ETH, you could also sell futures on crypto asset derivatives trading platforms. Futures are financial derivatives that enable traders to buy or sell an asset at a predefined price at a predetermined date in the future. Futures, therefore, allow you to bet on the price development of an asset without having to own it. The process of selling futures is effectively the same as shorting cryptocurrencies on digital asset exchanges or CFD brokerages, but requires a bit more understanding of derivatives. Hence, it would be an option for more experienced traders. As an alternative to selling futures, you could also use financial options to generate a potential profit in a falling market. Options are financial derivatives that provide the holder with the right but not the obligation to buy, or sell, an asset at a specific price on a predetermined future date. Let's look at an example. If you believe that the price of Bitcoin will lose over 50% of its value and drop below the $5,000 mark within the next 3 months, you could buy a Bitcoin put option with a strike price of $5,000 that expires in September. You will have to pay the premium, which is the technical word for the price of the put option. If the price of Bitcoin drops below the $5,000 mark, your profit will be the difference between the price at which you execute your option and the market price of Bitcoin, minus the amount you paid for the premium. Options are, therefore, a reasonably inexpensive way to short crypto assets, as you only lose the premium if the option expires and the strike price has not been met. However, due to the technical aspects of options, they are better suited for more experienced traders than beginners. With the US authorities targeting derivative platform BitMEX with civil and criminal lawsuits, It would be wise to use regulated platforms for all your cryptocurrency dealings.